are going to explain what's been happening on a macroeconomic basis, what this means for various markets that are of particular relevance to corporates, such as FX and interest rates, and share the latest developments and touch on some of the challenges that are facing corporates and how we might like to address them. Obviously, we'd like this session to be as interactive as possible, so please submit questions as we go through. You'll see a button on your screen that allows you to submit questions, and we'll try and tackle them as we go along, so please don't wait to the end to send them in. The session is going to be recorded, and the proceedings will be made available on the event portals shortly after the session finishes. Right, that's enough of the housekeeping, and so before we start, let me make some introductions. For those of you who don't know, I'm Sarah Boyce, and after many years of working in corporate treasury, I work providing policy and technical support here at the ACT. And today I'm delighted to welcome, and you'll be relieved to hear that we have some experts joining me. Colin McKee is Head of Financial Risk Advisory at Lloyds, and heads that financial risk team, advisory team in corporate sales. Sam Hill is the economist at the outfit. He's Head of Economic and Market Insight for Lloyds Bank Corporate Markets. Neil Crokey is Managing Director, Large Corporate Rates. He's the Rates Guru and runs the corporate rates team covering UK utilities and companies in the UK, Europe and the US. Last but by no means least is the FX guy. Rodri Hughes is Director in the Large Corporate FX Sales team at Lloyds. Right, that's enough for me for the time being. Let me hand over to the experts. So, Colin, would you like to kick off?
Thanks very much indeed, Sarah. Yes, as you said, these really are unprecedented times. And you can point to any number of newspaper headlines or market announcements over the past 2 or 3 months to confirm that. But I think the one that probably stuck out the most for me was from last week's Financial Times, where it quoted Andrew Daly, the head of Bank of England here in the UK, stating that the UK was set to enter its worst recession for 300 years, the fastest and the deepest recession since the Great Frost of 1709, allegedly. Quite something. Over the next 45 minutes, as we can turn on to the next slide, please, we will endeavour to put that into some context. I think it's fair to say that over the last number of years, there's been a relatively prolonged period of sort of relatively low volatility, maybe benign or favourable financial markets for corporate treasurers. This has very much come to an abrupt end, obviously, with the COVID-19 crisis. And we'll look at, as Sarah alluded to, some of the key areas of focus with respect to corporate risk management and corporate treasury over the next 45 minutes. So going through the different asset classes, FX, commodities and interest rates. We'll try and pull that together and look at what this might mean for Treasury policies going forward and how some of these risks might play out over the longer term. So I suppose without further ado, I'll maybe hand over to Sam on the economic side. I think before I do that, I'd probably say that whilst the COVID-19 crisis is obviously front and centre of everybody's mind at the minute, it's probably important not to forget that there's a number of other geopolitical and market risks in the horizon, so that even once we work through the current crisis, which will inevitably take some time, it may not be back to the sort of plain sailing that people are familiar with over the last number of years. So Sam, with that, over to you to maybe capture some of those economic risks.
Good afternoon, Colin, and welcome everybody. Thank you for joining us. Just 3 slides from me, quick 10-minute wrap up on the macroeconomics. So first slide, please. Next one, I think, and the next one, the first chart. Yeah, there we go. That's super. So yeah, we'll talk about some of the other risks, but it seems impossible not to start with the virus. And this chart here is a look at some estimates done by modelling from the OECD on the impact on G7 economies of the shutdowns on economy. And roughly speaking here, the interpretation of this chart is to look at the lost output in these economies for the length of time that each economy is under lockdown restrictions. So give or take, for most of these economies, you're talking about 25% of normal activity not being able to take place for the length of time that these countries are in lockdown. So, an unprecedented situation. And also here you can see an attempt to model that by sector. Now, clearly, very difficult to make these estimates, but I think by far and away, the most important point here is this is a very challenging position to be starting from, whether you're in the retail sector, the professional real estate, construction sector, or whatever. But I think the one thing that we can say, if we look at the next slide, is that there has been a huge amount of stimulus, both by the monetary policy makers and the fiscal policy makers. And what I'm trying to illustrate with this chart here is the monetary policy response. This chart shows 10-year gilt yields going back to late last year and all the way through to the start of May. And the point that I'm trying to illustrate here is that up until the point when the Bank of England announced its latest £200 billion of QE, the gilt yields were starting to rise quite materially. And this was in response to the fiscal packages that governments were putting in place, very costly. And I think investors were starting to worry about the levels of borrowing that would be required, and therefore demanding a high yield to absorb that issuance. Well, since the Bank of England introduced its QE programs, yields have collapsed, and they've been not just low, but also very stable. And I think this is the first important message from me, is that not just for governments, but also for consumers and for businesses that depend on interest rates, the fact that government bond yields are low will have an impact on the interest rates that percolate through to the rest of the economy. And it seems to me increasingly that the sort of language that we're hearing from central bankers suggests that this low, stable interest rate environment is going to be in place for a long time. So I think that's a key message on the rates front. If we go forward to the next slide, my final slide, you can see here some attempt to illustrate the size of the fiscal packages that governments across G20 economies have put in place. And you can see that for each economy, the bar that's shown is as a percentage of their own GDP, what their fiscal package they put in place is. For Germany, Italy, that's over 30%, the UK in fourth position there, almost 19%. So a huge range of total numbers, and also quite a range in terms of the composition of the stimulus. So a lot of the stimulus in those countries on the left-hand side of this chart is the government offering guarantees to bank loans or underwriting risk rather than necessarily funding programs up front, although the dark green bars show that those upfront interventions that do require government borrowing today, such as the job retention scheme in the UK, are in many ways very costly interventions too. And I think that may, in some cases, drive the speed of response in terms of easing lockdowns, because there will be some questions of fiscal sustainability. So I think the message here really is that these fiscal packages have been possible, but one of the main reasons that they have been possible is because the central bankers moved through QE to stabilise yields, such that the numbers that you can see on this chart, big percentages of GDP, have been credible and feasible without sending interest rates to high and destabilising levels. So what's the outlook from here, given that we've had that stimulus put in place? Well, I think really the main thrust of all of this public policy is to try and limit the degree of scarring of the economy. So it's inevitable that when economies are in lockdown, that there's going to be a loss of activity. By design, that's what's supposed to happen to a certain extent. But really, these fiscal packages are designed to ensure that when things do reopen, that the level of activity can get as close as possible, as quickly as possible, to where it was before the virus hit. And if that's the case, then the degree of scarring will be limited, and that will be a success. But if that's not the case, and if there is some scarring, then unfortunately the fear is that economies won't return to the pre-crisis peak quickly or immediately or fully. And I think that's really what we're doing now, is all of the attention of economists and market participants is looking at the degree of scarring and the risks, therefore, to whether or not there can be a V-shaped recovery, or whether we'll have more of a U or an L or some other shape to the recovery. Now, I think probably at this stage it's still too early to say, but it does feel as though a pure V-shape is on the optimistic end of things, and therefore, some of the other factors to consider during this period of recovery will be whether the lower level, if there is to be a lower level of economic activity for a short period and before we fully recover, whether that leads to a further period of fiscal tightening. There will, of course, be the question of whether other countries recover at the same speed as the UK, faster or slower. One potential concern in particular possibly is the euro area. We haven't seen interest rates in Italy, for example, their government bond yields be as low and stable as in the US and the UK. That might be a risk. And of course, there is the question of supply chain disruptions. That might be one thing to monitor and might be an impact on inflation further down the line. And of course, broadening away from the virus considerations, that leads on to the broader theme of trade disputes. And that's something which, of course, was a theme before the virus came along. And in that context, of course, economists looking ahead to the end of June to see what developments, if any, there will be in terms of defining the UK's future trading relationship with the EU. That, of course, is another big variable in terms of forecasts for levels of activity and potential frictions. Then there is, of course, the ongoing broader geopolitical risk too. There's a US election this year. So whilst at the moment all of the focus is on the virus, there are a number of other factors there that we've mentioned. But it does feel as though on the back of the Bank of England numbers that Colin referred to already, that we should be expecting a difficult year this year. But at least what we can say on the optimistic front is that policymakers have moved rapidly and decisively to try and create the best conditions they can for a healthy revival when the health judgments allow that to take place. So I think that's my 10 minutes just about coming to an end, and I will leave it there and hand over to the next speaker.
Sam, thank you very much for that. Some very significant economic impacts there, very clearly, and indeed sort of huge responses from central governments around the world. If we could move on to the next slide, please. Probably too long, I think. Yeah, exactly. So thank you, Sam. That's the macroeconomic backdrop. I suppose the next question really for us is how has that backdrop translated itself into some of the more micro risks and market levels that we deal with on a daily basis, and indeed that corporate treasurers have to face into on a daily basis and seek to risk manage. So over the next sort of 20 or so minutes, we'll take a look at some of those market levels and indeed some of the near-term themes and talking points that we've been discussing with our client base over the past few months in the initial phase of the crisis. We'll then also try and look forward, and very clearly none of us have a crystal ball, and I think one of the recurring messages that we hear from companies is that nobody knows what the future may be. It'll be truer now more so than it ever is, but we'll try and look forward to maybe some of the opportunities that these market levels might present, and maybe look to some of the activities that might be done in a slightly different way going forward. So we'll run through FX, commodities, interest rates, and we'll try and pull that together with a review of Treasury policies towards the end. So with that, I will hand over to Rodri to talk about FX and commodities.
Yeah, thank you, Colin, and thanks to the ACT for giving me the excuse to wear a shirt and trim the what I was claiming was rather fetching desert island beard that I've been cultivating over the last couple of months. While a snapshot of that might have been a fairly decent summary of my personal experience of lockdown, I've opted for something equally grisly, I'm afraid, in the form of these 4 charts on the next slide to capture the challenges of the pandemic for a corporate participant in FX and commodity markets. Truth be told, the first chart of UK manufacturing PMI could sadly have been any economic activity gauge from the last couple of months, as we've got that familiar sight of it falling off a cliff since the lockdown measures started to bite. Obviously, this provided the primary challenge of causing our customers to have significant revenue and cash flow losses. But many have also faced a second order impact where the exposures that they've been hedging through derivatives are simply not materialized. Now, while this isn't necessarily a problem if underlying markets haven't moved at all, as you can see from chart number 2, which shows sterling US dollar or cable and its implied volatility, markets have been on a little bit of a roller coaster, shall we say. As a result, the P&L impact has often been stark, and indeed the costs and cash flow impact of either closing out trades or rolling them over can be significant. And that's particularly true when you take into account illiquidity in markets and increased credit charges due to the higher volatility. Now, as Sam outlined, central bankers have done their best to re-establish some sort of semblance of smooth functioning of markets and providing a backstop to the economy. And as the third chart of euro-dollar spots and forward point shows, this has had a knock-on impact in terms of underlying pricing for hedging going forward. An exporter based in the Eurozone in a normal world now is looking at a much better position from a cost of hedging perspective when you look at spot and forward points. Similarly, as you can see in chart 4, an airline would have loved to have been buying jet down here in more normal times, but it's not exactly helpful if trade's being crushed and no planes are actually flying. Now, all of these factors have required an incredible response from you all, and thankfully kept me from spending all my time watching Netflix and doing virtual pub quizzes. But as with most issues that treasurers face, as you can see from the table on the next slide, there are pros and cons to any chosen path, and individual circumstances have often dictated how best to proceed. As you scan through the table on the left, I hope many of the points will chime with your experiences over the last few months. Have you been dealing with overhedged positions with negative mark-to-markets and considering whether to close out or to roll? Do you take the cash flow impact now or eat into valuable credit lines and pay a heightened transaction cost that might be involved when rolling? Similarly, with positions with positive mark-to-market, it may be worth restriking to market, or if the exposures don't exist, closing them out to free up counterparty limit and helpfully at the same time release cash. But how much is that going to cost? These short-term dilemmas are going to have lasting impacts on how you deal with FX and commodity exposures in the future, and indeed how you equip your staff with the expertise to deal with situations that are far from ordinary. One clear common thread would be the impact from having hedges in place that impose obligations. Are there different strategies or different hedging instruments out there that would provide a different outcome to those that you face today? Will you, in this backdrop, leave more exposure unhedged to avoid these kind of scenarios? Or will you look to actual option-based products despite the higher upfront costs? And if so, who's going to pay for them? Is it going to be your bottom line or the end customer? One other common theme would be around the perils of execution once you've actually decided what to do. I think it's fair to say FX markets and market participants are often championing the deep liquidity of those markets, but anyone dealing over the last couple of months will have potentially experienced sharp gaps across spot, forward and options markets. Risk transfer spreads have widened and auto pricing limits on platforms have come in. In this environment with non-standard transactions in terms of size and indeed profile to execute, we've had perhaps forgotten methods such as working at best orders or heaven forbid, dealing via the phone again. They've made a bit of a comeback as customers look to get certainty of execution and to minimize their costs. I guess an open question I would pose for you all is whether you feel your colleagues, employees today, who are used to perhaps an era of pushing BAU type trades through a platform, have the experience to explore these other alternatives with their liquidity providers. Sometimes the short-term cost-efficient approach won't always be so in the long run. Now, while you ponder that, and before I hand over to my colleague Neil for the topic of rates risk management, I thought I'd leave you with a quick case study on slide 10 to bring these themes to life. Now, by far the most common and indeed pressing issue in my space over the last couple of months has been around dealing with overhedged positions that have significant mark-to-market. Clearly, corporates haven't wanted to expose themselves to further P&L volatility post de-designation of these hedges. And where rolling to future dates has not been possible, they've often had to close them out with sometimes significant cash flow implications. In this particular example, however, we had one corporate in the relatively fortunate position where some of their overhedged position was in the money and able to actually act as an offset for the negative impact coming from other parts of their book. As the slide outlines, this UK consumer goods company had a portfolio of in-the-money cable forwards where they were buying dollars at better than the market. And on the flip side, they had a portfolio of out-of-the-money diesel swaps where they'd locked in their purchase price much higher. As you would expect, they considered all the available avenues to them. Could they roll it forward to future dates? Potentially, but the forecasts were none too certain, and they're still none too certain. And credit appetite needed to maintain for other requirements. They could have also looked to have traded the other way around and closed those trades out in isolation. But again, there are issues there in that they could have closed out one trade, and by the time they got round to the other, the positive mark-to-market on that wasn't enough to compensate for the negative on the trade that had already been closed. And instead, they ultimately settled on closing out the trades together, working with us to get efficient execution in highly illiquid markets and ultimately achieving the desired cash neutral outcome. This has left them in a much better space with credit line there in place to act as and when those forecasts become a bit more concrete once again. Now, hopefully that relatively nifty bit of risk management was a good example of what your peers are having to do in these challenging times. And for more on that subject, over to you, Neil.
Actually, Neil, just before you start, Neil, just a couple of questions for Rodri. One is, do you think that the official sector feel like they've normalised the FX and commodities markets already? And I guess possibly connected, the other question is around liquidity. And clearly the markets are a lot less liquid at the moment, but is that the new normal? I mean, there was some debate even before the virus that actually FX markets were becoming less and less liquid. So even if this hadn't happened, would we be expecting to see less liquidity?
I mean, there's certainly an argument I've heard many times that the regulation that was put in place post 2008, which ultimately has been all about ultimately trying to make banks safer, has had the unintended consequence of potentially making markets more fraught. I'm talking about the ability of banks to be there to actually provide liquidity, which can be quite difficult when you've got stuff like the Volcker rule in place, which makes it difficult for them to have outstanding trading positions and what have you. So I've certainly got some sympathy with those that do say, regardless of the current situation, we've been moving to a position where markets have been a bit more fraught. There's also the fact that they tend to be dictated a lot more by algorithmic execution, and by that I don't mean sort of algorithmic order execution, but actual algos that are there trading in milliseconds around news headlines, which when they see a headline, they're programmed to buy sterling in droves, and it can make liquidity just disappear. So there are market dynamics that have made it a bit more fraught in certain markets. But then on the flip side, you see the BIS's survey, which comes out, which shows the numbers in ever escalating trillions of daily volume going through. So it's a bit of one half a dozen the other. Anecdotally, it does feel to me, certainly against the backdrop we've had since 2016, in the case of sterling, for example, we do seem to go through these bouts of extreme illiquidity in spot, swaps, in options, where there just sometimes simply isn't a market there anymore. So while you can be absolutely fine the vast majority of the time, it may just be sod's law, if you excuse my language, where it's your time to execute something sizable at the same time as a headline comes out, and the market just isn't really there. In terms of normalizing, the current markets, I'd say it's got better. You look at the first chart I showed around sort of volatility coming back. We've moved away from the extremes that we saw perhaps in the middle of March. But, and it's a big but for me, dealing with UK customers who are very, very focused on sterling, it seems to be that we're never too far away from another potential headline that could see significant gappy price action once again.
That's really helpful, thank you. I think from my perspective, that reinforces, because I've been in Treasury forever, and back in the day, we'd have rolling hedging programs. It sounds very much as though, certainly in the world of FX, having rolling FX programs or hedging programs is probably a prudent approach at the moment, just because of the level of uncertainty that people are seeing.
And look, I think ultimately with programs, I think ultimately you've got to devise them so that they suit your business. I think our sole contention would be, well, two sole contentions, if that's possible. One, you can have hedge funds who, they spend all their day trying to pick the right level in the markets, and they will ultimately get it wrong. And they're often cited as the smartest people in the room. So having a sort of regular systematic program where you look to smooth the impact of markets over time seems a very defensible strategy to me. But the addition we would suggest to that is build in flexibility to your policies in terms of the instruments you can use, or have different ranges of cover that you can use, so you can flex it according to the circumstances at that time.
That's really helpful. Thank you very much. Sorry, I interrupted. I think we were going to move to Neil next. Sorry.
Absolutely. Over to you, Neil.
Thanks, Audrey. Thanks, Sarah. So we can move to the next slide, please. Much like the FX slides, I've tried to encapsulate impacts on the fixed income markets of COVID-19. And I do feel a little bit like the boy who cried wolf about rates being at or near historic lows. It seems to be like a yearly occurrence over the last 5 years. But to try to show just the move that we've seen in sterling, on the first graph, we've shown the progression of the sterling swaps curve out to 20 years since the beginning of the year. And you can see it's been quite a fall in rates. I think probably what's been more interesting from a rate perspective globally is just how rates have converged as central banks, as Sam pointed out, have acted early and acted quickly with monetary policy. And I think that might be interesting for the corporate community as they think about currency mixes going forward. On the third graph, also what's been interesting is the decoupling again of LIBOR to overnight rates. Obviously, the bank, in this case, we look at LIBOR versus SONIA. The Bank of England has been quite active to pump liquidity in and proactive in cutting rates. However, LIBOR rates haven't fallen base rates or indeed overnight rates lower, rather the opposite, and have increased. I think this again highlights the risk to the LIBOR byproduct, if you like, that there is an inbuilt credit risk to that index. And certainly, I guess, will be something that will be followed by regulators as they think about the transition from LIBOR to SONIA over the next 18 months. And then finally, I think it'd be wrong not to look at the impact of credit spreads. Clearly, we saw quite a widening in credit spreads once the full impact of the crisis was known. But given the actions by central banks globally, those credit spreads have snapped back, and that's probably despite what's been quite a busy time in terms of issuance for the corporate sector, as they've sought to bolster liquidity. And I guess one observation on this is that, albeit even though credit spreads are considerably wider, that has been offset to some degree by benchmark yields, whereas all-in borrowing costs are marginally wider, but not significantly so. If we look to the next slide, please. So what does this mean for the corporate treasurer from a rate perspective? Well, just thinking about what we've seen over the last 6 to 8 weeks since we've been in lockdown, I think very much similar to the FX world, we've seen restructures or companies looking to restructure existing hedges where possible. Similarly, as releasing near-term liquidity, or indeed managing down credit exposures that they have to their own swap providers to free up limits for them to do transactions elsewhere. There's also been an increased focus on pushing back the timing of cash flows, clearly in line with the business profile where potentially EBITDA levels have dropped in response to consumer activity. But also we've seen, as you'd imagine, changing in tactical views. So can corporates can they use the current market to respond to potentially add value for future years? And I think one of the obvious and most common discussions we've been having with our corporate base is the idea of pre-hedging, or indeed increasing the proportion of fixed. Now, this has obviously a couple of ways you can do this, whether it's locking in rates ahead of future issuance, but also reducing exposure to LIBOR dislocation, with corporates asking themselves that have been lucky enough to have floating rate exposure, whether there remains further upside to retaining that floating rate exposure. One of the things that we have been working with our corporate clients on is to kind of devise hedging strategies, and indeed looking at the current market to determine whether it is an appropriate thing for them to be looking at pre-hedging. We use a scorecard approach where we use a number of different factors, such as the absolute levels of benchmark yields or swap rates, the cost of forward hedging, and indeed implied volatility levels. Scoring these on a range of 1 to 10, we can determine whether or not it is an appropriate thing to do for the corporate to enter into pre-hedging.
So
next slide, please.
So is that scorecard something that perhaps the corporate could do for themselves, or is that something that you do internally?
Well, it's something that we do internally. I think it's more for Colin. It's one of Colin's team that has developed this. I don't know if you want to comment on that.
Yeah, sure. Happy to comment on that, Neil. Yeah, it's one approach to trying to put a sort of quantitative lens on pre-hedging or fixing. There's many approaches, and qualitative factors would need to be taken into account as well. But I mean, this is one approach that we actually developed with the corporate going back probably 6 weeks ago, 2 months ago, just to try and put sense. We looked at the absolute level of yields, the steepness of the curve, so how much they were maybe paying forward starting hedge, that mapped the timing of some of their bond maturities, and indeed looking at the implied volatility in the market, which is probably a little bit higher than it is now as volatilities come in again. As with all these things, though, one approach, there's probably no right answer, but this is really just trying to put some thinking and analysis around that the sort of quantitative question around pre-hedging.
Oh, it's really helpful to understand. Thanks. Sorry to interrupt.
Thanks.
No problem. Can we have the next slide, please? What we've looked at here is just to consider again the convergence of global rates. One of the things your corporates will look at in the coming months is whether or not the current mix of debt is an appropriate one. Historically, corporates have typically balance sheet in those currencies with lower interest rates for obvious reasons. An example of this is U.S. corporates borrowing in euros at possibly less economic levels than issuing dollars and swapping, so that they can gain a benefit in the interest rate line and consequently an EPS benefit. But with lower rates globally, there may be opportunities to rebalance the debt mixes across currencies away from necessarily historically low rate currencies such as euro or indeed Swiss franc. This may be particularly timely in the context of higher leverage levels, where ratios may have less headroom to absorb currency moves. Next slide, please. And then one final slide for me, and maybe slightly counterintuitively, should you consider adding floating rate? Probably one thing that's been overlooked in terms of floating rate borrowing is its effectiveness of hedging against cash balances. And because corporates have typically looked at cash balances as being, I guess, in some degree cyclical, considering that floating rate as a balance sheet hedge against those cash balances may be something that has been overlooked. Obviously, though, with corporates holding higher levels of liquidity, floating rate exposure will provide an economic hedge against that, and indeed, in some cases, may reduce cost to carry against those balance sheet hedges. So I think this is something that we have been looking at for some corporates, not all, but we show a case study here where recently we had a corporate we had been working with was looking to target higher levels of cash balance or higher levels of floating rate exposure, and took the decision, despite the curve shape and the absolute levels of rates, to swap a new fixed rate issue to floating, and indeed, looking ahead to LIBOR transition, chose to hedge using SONIA rather than LIBOR. So I think that was an interesting development. I think it's one that we will expect greater conversation around as we turn our attention to LIBOR transition more generally in the second half of this year. So now I'll hand it back over to Colin, who will consider how Treasury policies may adapt in the current environment.
Thanks very much again, Neil. If we could move on to the next slide, then please, slide 15. There's probably a world of things we could cover in this topic. I think it's a broad topic, but I'll try to stick to two or three, I think, in the interest of time. When we look at companies' reaction to the COVID crisis, in terms of where we are at the minute, I suppose one of the things that we've noted is that a lot of companies have maybe dealt with their initial near-term priorities. So, if you like, the sort of firefighting stage of the crisis, if you want to call it that. They've maybe addressed their immediate liquidity needs. They've looked to secure additional funding to get them through the next 12 or 18 months or longer term. And they've started to deal with the huge changes to operating models and business models and so on. I think much of that has maybe been done. I mean, don't get me wrong, there's still a lot to do perhaps for some companies, but a lot of the companies we talk to are maybe now at the point where they're in a position to take stock of the sort of longer term view, if you like, in a more measured way. And as part of that, one of the obvious things that a lot of companies we talk to are looking at is Treasury policies and asking themselves whether or not those policies are suitable for the current environment, given the huge changes that have taken place. So to call out maybe sort of two or three key points in relation to adapting Treasury policy, I suppose first and foremost, as Rodri alluded to earlier, I think what a huge number of companies are looking at the minute and are dealing with is simply understanding what their risk exposures are. So forecasts are likely to have changed enormously. Business might have dropped off a cliff for some companies. Other companies might actually be seeing an increase in potential cash flows. regardless of the circumstances, most companies will have been affected in a very material way. So they'll need to adapt their forecasting processes to capture the range of potential outcomes that might occur over the next 6, 12 months, longer term, and to update those forecasts on a much more regular basis than would have been the case previously. On the first point around, adapting the forecasting processes, we think it's really important for companies to build scenarios into their forecasting models, so to look at a range of possible outcomes, both in terms of the quantum of cash flows and indeed the timing, without building so many scenarios that the central message becomes confused. So I think one of the treasurers on the earlier session today referred to this as scenario paralysis, where they're simply trying to model almost too much that the message becomes a little bit lost. I think once that's been done, then these scenarios can be stress tested in order to understand the impact of market risk and cash flows and key metrics, if you like, to understand the set of events that breaks the business or puts the metrics under undue strain. And indeed, this is going to be increasingly important where financial metrics have come under pressure and under stress, given potentially reduced operating cash flows, potential increases in debt levels, etc. So companies will need to review their risk appetite across key metrics in light of those uncertainties and potentially reduce headroom to some of those metrics. Secondly, once the forecasts and scenarios have been built and the exposures of the company are understood, or at least the range of potential exposures are better understood, then I think at that point companies can really start in earnest to look at their treasury strategies again and to look at how they can address some of these risks. I won't dwell on this point. I think it was touched upon earlier with Rodri and Sarah. But this is perhaps an opportunity to fundamentally review what those hedging strategies are trying to achieve, what the objectives are, and maybe challenging the status quo. So I think the earlier example was around hedging FX transaction risks, and maybe commonly companies have used rolling or layered strategies across an 18-month or 24-month time horizon. So is that the right approach? I think, as we said earlier, it seems very defensible in the current environment. But probably one of the key questions is, how can that approach be tailored to deal with a range of potential forecast outcomes with respect to timing and volume? So that would probably bring me on to the third point, one of flexibility and adaptability. And in our opinion, at times like this, it's absolutely vital that companies look to try and build in flexibility into those hedging policies and make sure they're adaptable and able to adapt within a sort of adequate time frame. We said earlier that this was something that we've been discussing and many companies have probably been discussing pre-crisis, but obviously the ability to be flexible within your given strategy comes to the fore at times like this. So how might you build in flexibility? Well, there's a number of ways in which you can do it. There's probably a wide number of ways. One might be hedging instruments. So for example, do you look at purchase options to deal with forecast uncertainty, or to take out tail risks but leave upside benefits in place? This obviously might increase the cost of hedging due to the premium payable, but it obviously helps to deal with those downside risks or tail risks, or deal with sort of uncertain forecasts, if you like. Other ways might be allowing flexibility within hedging ranges. So if you have a particular range of 50 to 75% cover over a time period, how might you make that more flexible? Do you sort of allow flexibility within the range? And indeed in the execution approach to enacting some of these strategies. So thinking through what the best execution approach might be if market volatility remains or returns. Do you, for example, leave orders trying to target particular levels for FX transaction hedging? So there's a number of ways that flexibility can be built in. And then last but not least, looking at the relationship with your banking group. And in particular, I think it's going to be important to stay close to your banking group over the coming months and to engage proactively with them. There's again a number of reasons for this. Obviously, as forecasts change, banks will need to and will want to understand the impact on the business, understand what they can do to help in terms of providing liquidity support, understanding the company's credit position, so what that might mean on availability of credit lines, etc. And indeed, as well as that, I mean, banks, I think, need to and want to be there to be able to provide market insight and colour for companies to help them through these periods of volatility. So, for example, by helping companies to understand better investor demand, pricing, maturities, etc., in the bond markets or in the loan market. So looking at availability of loan market financing. Is there a 5-year market? Is it only 3 years, for example? What's happening with pricing? And also, indeed, some of the additional insight and services that banks can provide. So maybe helping with some of the points that I touched on earlier, looking at trying to sort of model the impact of market risks on some of the cash flow scenarios. So very briefly, just moving on to the next slide, we have put a very brief example of some of the work we've done in the past, helping a company to look at its Treasury policy. I'll go through this very briefly in the interest of time, but this was a UK company looking at its FX transaction hedging policies. This was pre the crisis, so this was dated back to late last year. And the main questions were, number one, is the existing sort of rolling/layered approach correct? And number two, should the company think about extending the maturity of its hedging program? So tactically, it quite liked the market levels and maybe wanted to lock those in for a longer tenor. And if they did that, what were the key questions? How could they build flexibility into that approach? Because they ran the risk of that approach putting them slightly out of sync with their peer group. So in this instance, we were able to help the company model its cash flows and in particular look at trying to attribute risk to particular currencies. So the flows in question were a number of G10 and emerging market currencies. The little chart in the bottom right tries to attribute risk to each of those currency flows. It then looks at diversification to get a net risk figure. And then the chart in the bottom right looks at different potential hedging strategies. So this one in particular is really just for sterling euro, looking at the impact of the current approach. So the sort of smoothing that results from this sort of rolling or layered approach versus a smoother layered process over a longer term. So the light green line on that chart is obviously much smoother. Now that analysis can obviously be extended, and one of the things we talked about with this company was indeed looking at including options if they were hedging for additional tenors so that they wouldn't be caught offside relative to their peer group. So this probably emphasises the last point that I made in the previous slide, that it may be important to sort of stay close to your banking group over the coming period and indeed look at ways in which they can assist you, because most corporate treasury departments at the best of times are pretty light. So there may be a lot of heavy lifting to do over the coming months. And this is one example of ways in which banks can maybe assist corporates to get through some of that work. And
Colin,
that really concludes, I think.
Sorry.
Sorry, Sarah, I think I cut across you.
No, that's okay. It's exactly what I was going to say. I think that's a really good spot to leave. I think that's. Thank you very much indeed, all of you, for your insights over the last 50 minutes, actually. It's been very, very interesting. I hope everybody's found it helpful and informative. I certainly have. And hopefully that we've been able to give you a number of things to consider as you review risk management strategies, how they may need to change, both as a result of recent events, but sort of the longer term events that have been alluded to. I think the key message of keeping close to your bank is one that we would all do well to bear in mind. I would like to thank Lloyds very much indeed for your time this afternoon. There are other live stream sessions that will be going ahead today, so please do join us back later in the day. And there are a number of pre-recorded sessions as well that are available to watch now. Finally, I'd like to thank Colin, Sam, Rodri and Neil, and to Lloyds Bank, the sponsors. Thank you very much indeed. Goodbye.
Thank you.